Welcome to your first time homebuyer's guide. Today I'm going to walk you through the home buying process from start to finish, likely starting with where you currently are at in renting, all the way up until when you're handed the keys, moving into your very first property that you will own. My goal is to help educate you so that you can better understand the process and what to expect along the way, and therefore make better decisions for yourself and your family when you're looking to buy your first home. My name's Connor Webb. I'm a mortgage loan originator, and my team can assist on home loan financing in all 50 states. So if you have any questions about any steps of the process, feel free to reach out either via email or you can visit my website. All of those details are in the description below. The first step of the home buying process is planning your finances. There's a few questions that you'll want to have answered before you even begin the pre-approval process. You'll want to figure out how much money out of pocket you're willing to spend both monthly and upfront for the purchase. The typical closing length for a purchase from start to finish is going to be 30 days. It's also worth noting that a mortgage lender is not a financial planner. A mortgage lender will help you figure out your max sales price of what you can qualify for. A financial planner would help you what would fit within your budget. So you'll want to come into the pre-approval process ready to know what you can afford yourself, how much you're willing to spend on a monthly basis, and what really fits within your budget for a purchase. Now, as far as your monthly costs are concerned, how much per month do you want to spend on your housing payment? There's a slogan called PITI, and then I added a plus. PITI stands for principal and interest on the mortgage, your property taxes, your hazard insurance, mortgage insurance, and then also any additional payments such as an HOA. As I previously described, you'll want to come into the pre-approval process with a certain monthly payment, a max amount that you're not wanting to exceed in mind, so that when you do figure out how much you can qualify for, that you're staying within your budget and you're going to be comfortable with making that mortgage payment on a monthly basis. On top of the monthly expenses, there's going to be various upfront costs in order to purchase a home. One is going to be the down payment amount, as you can see below, depending on which loan program you qualify for and is best for your situation. The down payment amount will vary. For a well-qualified first-time home buyer, so someone likely with a 720 credit score or higher, if you are using a conventional loan, the minimum down payment is typically 3%. If your credit score is below a 700, then likely we would be looking at an FHA loan, which has a down payment requirement of 3.5%. Typically, FHA loans are best for people with a 580 credit score all the way up to 700, but you can qualify with an FHA loan technically below 580. It would just require a higher down payment. Typically with an FHA loan, if you have between a 520 credit score and a 580 credit score, it would just require a higher down payment, typically 10%, but you can still qualify with below a 580 credit score. There's also a couple loan programs in the USDA loan and the VA loan which require no down payment out of pocket. There are additional requirements for you to qualify for those loan programs. For example, with the VA loan, it's for veterans only. There are also various down payment assistance options which will help reduce your out-of-pocket upfront expense. But as you can see, it's a common myth that you need a 20% down payment in order to purchase a home. In all reality, that number is much lower than you would think. On top of the down payment, there will be various closing costs and prepaid items which will be factored in and will need to be paid at closing. Typically, this ranges from 2 to 4% of the sales price, depending on your area, depending on your loan amount, and various other factors. Some of the closing costs that you can expect are various lender fees. So depending on which lender you go with, they might have processing and underwriting fees. If you decide to buy down your interest rate, or if there's a cost for your interest rate, then that would be factored in. There's also going to be an appraisal that you'll have ordered, which is technically ordered through the lender. There will also be something called an escrow or a title company, who is essentially the middleman between the buyer and the seller. That's where all the funds will go to, and then they will disperse from there. They also help with the transfer of title from the seller of the property to the buyer of the property, so that ownership is officially transferred to the new homeowner. There will be multiple parties helping in the process along the way, so the closing costs are essentially paying each of these companies for their services. As far as prepaids are concerned, depending on which month you end up closing in and which day in the month you end up closing in, there's going to be a certain amount of prepaid property taxes, property insurance, and mortgage interest that will be due, and you'll typically prepay these items from the date that you close through the end of that month. On top of these items, there will also be some out-of-pocket expenses such as the home inspection that you might pay through the process. Another key piece of planning your finances is going to be figuring out your why. Why are you buying a home? It's important to be clear on your why throughout the process so that you make sure to stay within your budget, to stay within your timelines, to move quickly if you need to slow down if you need to stay clear throughout the process on why you're buying the home so that you don't let the emotions of the home buying process get the better of you at times. Now, step 2 of the home buying process is going to be finding a lender. So once you have those personal questions answered about your budgeting and your personal finances, this would be your first step directly after that is to talk with a lender to determine if you can get a loan and how much you can get pre-approved for. Now, in order to find a lender, there's a few different options. One, of course, would be to use myself, reach out via email that will be in the description of this video. The second option is to use Google search. You can look at Google reviews of past clients and their recommendations. You could also ask a real estate agent for a referral to a mortgage lender, or you could ask a friend that has bought a home recently to refer you to their lender. During this process, you can go online to start checking rates to see where things are trending, where the average interest rate is at. I will caution you that when you go online and start looking at rates, your interest rate is going to vary depending on your personal situation with your credit score, your down payment amount, your loan amount, various other factors. So I would caution you on looking up interest rates in this fashion and more so connect with the lender, get pre-approved, and they'll tell you where rates are at depending on your situation. It's also worth noting that mortgage interest rates fluctuate on a daily basis. So if you were to get a quote from myself last week versus today versus a week from today, the numbers will be different and the changes can be anywhere from small to significant depending on what is happening in the investment markets and the economy. Step 3 of the home buying process is the actual pre-approval itself. So why would you want to get a pre-approval? Well, during this process, we'll figure out the ideal loan type for your situation. We'll figure out the max purchase price that you can qualify for. We'll figure out the interest rate range that you're going to be looking in depending on your situation. We'll also figure out the down payment amount that will be ideal depending on your loan program and how much you have in assets to bring in for your cash to close. We'll also go through the various estimated costs that I mentioned earlier. During the pre-approval, you will have to gather certain documentation to send into your mortgage company so that they can verify various information. I would recommend just starting a Google Drive and uploading all of these documents into that folder. You can then share the link to that Google Drive folder with whoever you're getting pre-approved with. That will keep things easy and simple. It's all in one spot, and you could always refer back to that if needed. Some of the basic documentation to gather up are going to be 30 days of pay stubs, 2 years of W-2s or 1099s, depending on if you are employed or self-employed. You might as well upload your 2 years of tax returns to this file as well, 2 months of bank statements, and then your driver's license as well for the pre-approval. As I mentioned, if you just start a Google Drive folder, you keep it all organized in this one place. Make sure to label everything accordingly. It'll make it easy for your mortgage loan originator and also for yourself throughout the process. Now, what can you expect during the pre-approval process? The first step is going to be getting an application completed. Depending on your preference and the options that your mortgage loan originator have available, you'll either fill out an application online, you can do it over the phone, or if you meet in person with your lender, then they can fill it out in person. There will be a hard credit pull throughout the process so that we can see your full credit report, all of your debts, your liabilities, any late payments, your credit scores, and figure out your qualifying. As far as a credit pull knocking your credit score, I wouldn't worry too much about this. The hard inquiry typically knocks your score a couple points, and actually once I have a credit report pulled, I can run a credit simulator if we're close to the next tier of interest rate pricing. Like if we can boost your credit score up to the next tier, I can run a simulator to see exactly which accounts you need to pay down and which balances you need to pay them down to if we're trying to boost your credit score in the short term. So as far as the hard inquiry and the amount that it'll affect your credit, I wouldn't worry about that. Next, you'll send in those documents that I already mentioned to upload to the Google Drive folder so that your lender can verify your income and various other factors. You'll then receive a pre-approval estimate depending on all of the factors of your file. And then finally, you'll receive a pre-approval letter when you're ready to make an offer. I will note that for my clients, I always customize the pre-approval letter specific to the offer that we agree on with your realtor. You're not wanting to show the seller that, hey, you can actually qualify for a higher sales price. So when you're deciding which mortgage lender to use, I would recommend using the one that you feel the most comfortable with depending on the information that they've given you and the experience that you've had up through the pre-approval process. And then when you do pick a lender, you're going to make it easier for yourself and everyone else involved if you just pick someone, stick with them. Whether that's myself or someone else, I would recommend to just pick one and work as a team to get through the finish line. And then some big don'ts in the process once you're pre-approved: do not make major purchases, especially if that means adding debts. If you were to add a debt payment to your debt to income ratio, that could potentially take you out of qualifying and reduce the amount that you would qualify for. Do not change or quit your job because, as you might imagine, changing your income source or getting rid of an income source completely might affect your qualifying. Do not move large amounts of money around in different accounts. We will have to source where certain deposits are coming from, so I'd recommend just keeping your money where it's at until you advise with the mortgage lender. Also, make sure not to pay off any debts or collections beyond this point before advising with your mortgage lender, because during the pre-approval process, you're figuring out your down payment amount and your cash to close that you want to come in with. If you were to pay off a debt or a collection and reduce your out-of-pocket that you have available, that could kill a deal. Also, another big one is do not make late payments. Your payment history is your biggest factor in determining your credit score, so a late payment would have a massive impact on your credit score. Once you have the pre-approval process wrapped up, now it's time to find a real estate agent. A few guidelines when finding your real estate agent is to not use a dual agent. That means do not use an agent for both the buy side and the sell side of a property. You want one agent that's on the buy side and then one that is different on the sell side, so that both of the agents are working in their individual parties' interests and that there's not one agent that's taking care of the entire transaction. You want to make sure that it's balanced. I would also recommend explaining your situation in detail to whichever real estate agents you're interviewing to see what their thoughts are on your situation and how they would go about looking for homes. I would also make sure to weigh helpful versus salesy, kind of similar to with picking your mortgage loan originator. Same thing with a real estate agent, finding that balance between helpful and salesy. It's also worth noting that experience isn't quite everything. There's going to be real estate agents that are relatively new to the game that can provide just as good of a service or better as someone who flaunts their 25 plus years in the game. And as with everything else, just go ahead and trust your gut with the real estate agent that you feel like is going to service you the best and that you feel the most comfortable with. Now, where can you find real estate agents? Well, one would be to ask me for a referral. Once we get you pre-approved, I can recommend you to a real estate agent that I highly recommend. Number two would be to do another Google search, look at Google reviews, see their past clients' thoughts, and pick that way. Another option would be to find one of those agents that are on Zillow. If you're scrolling for properties on Zillow, there's always the agents down below. You might already know an agent from a prior experience or from a family member. You can get a referral from a friend. And also, as of note, as a buyer, the buyer agent is usually paid by the seller from their listing commissions. But when you're interviewing realtors, I would clarify and ask them how they're paid. So once you find your real estate agent, the next step is to go ahead and get shopping for homes. I would recommend to follow your agent's MLS updates. They'll be sending you various properties on their real estate search. Go ahead and look through the properties that they're sending you so that you know which properties you actually want to go and look at. Also, make sure to stick to your lender's max price limit and your monthly budget so that you're not going above a price point to where you'd be uncomfortable on a monthly basis or where you don't even qualify for. Make sure to use that why that we established earlier to set a timeline and urgency. Also, make sure to make a needs versus a wants list that you can give to your realtor to see what is mandatory for a property versus what might just be a want. When you're shopping for a home, make sure not to get emotionally attached. Properties can move quickly at times, and you might not win every offer, so try not to get emotionally attached to a certain property. Also, do not move too fast or too slow to schedule a showing. You don't want to be moving too fast to where you're seeing every property under the sun, but you also don't want to be too slow to where you potentially miss out on an opportunity. And also, don't feel like you need to see every home. If there's a property that is not on your needs list, but it's more on your wants list, you might not need to see the home. Step 6 of the home buying process is going to be actually writing an offer on a property. So how does this work? Well, you can negotiate more than the sales price. When a property is listed for a certain amount, there's various ways that you can make the offer. You can negotiate above or below the sales price. You can ask for concessions. You could ask for an extended closing. You can negotiate for something that's on the property to remain with the property after it's sold. When you submit an offer, the seller can accept or counter your offer. Or if there's multiple offers on a property, typically that listing agent is going to be pretty transparent with all of the realtors that are assisting their clients with offering on that that property to recommend what they would need to do in order to win that deal. If a contract is accepted, then the contract will become the map of the transaction, and those contracts are binding. Some tips when writing an offer is to write an offer that helps you win. You can ask your agent with how you can make your offer more competitive and strategize with how you want to write that first offer to help give you an upper hand on potentially some other people. You'll also want to ask your lender to call the listing agent to vouch for your qualifying so that if they do accept your deal, you can assure them that the financing is going to go through and that there won't be any problems until closing. So then you write an offer and your offer is accepted. You're now under contract on that property. The next step is going to be to get your home inspection completed. The home inspection is for your benefit, and it's one of those out-of-pocket expenses that we mentioned at the beginning. A certified home inspector will examine the home to see if there's any glaring and big issues with the property. You'll get a full inspection report listing exactly what the inspector found, and in that purchase and sale contract that was signed around by yourself and the seller, it will determine if and when you can negotiate repairs to be fixed by the seller. You can also negotiate a concession with the seller. And the home inspection is a potential big moment in the process as there can be some big changes to the contract. If you, the buyer, get the home inspection back and there's a ton of red flags, you can back out of the contract at that point. You could also request the seller to repair various items to give you a concession to help contribute towards the cost that those repairs will cost you, or you could even renegotiate terms of the contract accordingly. Once the home inspection process is ironed out, next will be the underwriting process. Your mortgage lender will take your loan file as it's currently structured and the documentation that was gathered at the pre-approval process, as well as any additional documentation that was gathered after you got under contract, and they'll send everything to the decision maker of the file, who is the underwriter. The underwriter wants to make sure that you have the ability to repay debts, and they'll take a look at your loan file, how it's currently structured with whichever loan program you're going with. They'll look at all of the documentation that is currently gathered, and they'll look at the guidelines for those loan programs to make sure that we have enough that is needed to prove that you have the ability to repay that debt. Your loan originator will keep you updated throughout the process as they hear back from underwriting. If you get something called a conditional approval, that is totally normal. That is an approval, but a few additional items are needed. Also, at this point in the process, you'll want to get your homeowner's insurance coverage dialed in. Homeowner's insurance is to cover in case there's a fire, flooding, natural disaster, anything that happens to your property to where you would need to pay for a certain expense. You do get to shop for your homeowner's insurance to find the coverage that fits you best. As we mentioned at the very beginning with the PITI, the monthly payment, that second I stands for insurance. Your homeowner's insurance will be a part of your total monthly payment that you'll make on a monthly basis. There is also a full year that is paid upfront, which is a part of those prepaids that I mentioned. Also taking place during this will be your home appraisal. The home appraisal is mainly for and ordered by the lender. It will be paid for by the buyer out of pocket, one of those expenses. But the appraisal is basically to prove to the lender that the value of the property is high enough and that the loan amount that they're lending on that property is sufficient based on the loan guidelines. Ideally, the appraisal value will be at or above the purchase price of the contract. The lender will use the lesser of the purchase price or the appraised value as the effective value for their loan. The appraisal inspection will be scheduled and then the report will be sent to you after the appraiser completes the report. Looking at a couple scenarios with the appraisal, here is scenario one. Let's say the purchase price is $500,000. The appraisal comes back at $520,000. All is well and good. The effective value for the loan would be $500,000. That's what the loan amount is based on. There's no issues here. And you walk into some instant equity, that $20,000 that the property is actually worth, whereas you're paying $500,000 for that property. Scenario two, there would be some issues here. If the purchase price is $500,000 and the appraised value comes back at $475,000, the effective value for the loan would be $475,000. That's what the loan amount is based on. So in this scenario, there would need to be some tweaking to the financing. One option would be for the buyer to come in with a difference between the appraised value and the sales price. So the buyer comes in with an additional $25,000. Another option would be for the buyer's agent to negotiate the sales price down on the property. So lower the sales price to $475,000. There are other options that can make this scenario work, but it is definitely less than ideal. Once we get the appraisal back, we're now that much closer to the final step of the home buying process, which is the closing. So first off, we'll need the clear to close on your loan. Once you have your homeowner's insurance policy lined up and your appraisal comes back at value, We can then submit everything along with all of the documentation we've gathered to underwriting, and that's when we would get your clear to close from underwriting. That means that everything is done on the loan side. There's nothing else to worry about or to gather. You'll then schedule your final walkthrough 24 hours before closing with your realtor to check out the property, just make sure everything is good and dandy. You'll also be sent a closing disclosure, which will show you a breakdown of all the different costs throughout the process. There will be something called a loan estimate that would be sent at the very beginning of the process once you're under contract, showing the initial estimates. Through the entire process, your escrow and title company, as well as your lender, will be working to dial in these various costs. And so typically the costs that show up on your closing disclosure will be less than what shows on the initial loan estimate. Once all of this is reviewed and figured out, you'll get your closing signing scheduled. This is where you'll be hand signing all of the final documentation at the escrow company's office. At this point, you'll be reviewing all of the documents and ask any questions that you might have on any of the fine details. You'll also get a copy of all of these closing documents. You'll also pick up the wiring instructions that you can go drop off at your bank so that you can wire the final funds for closing to the escrow company to complete the transaction. Your keys and the occupancy status will then be exchanged according to your contract. And on the day of closing, that's typically when the transaction records with the county, then you'll officially own that property. As far as the first mortgage payment and beyond that, the first payment is usually due in over 30 days from the close date. For example, if you were to close on May 15th, at closing, you would be prepaying for the remainder of May's payment. The next month in June, your first payment will be built up, and then that first payment, that June payment, will be due July 1st. So typically, if you were to close May 15th, your first payment on your mortgage wouldn't be due until July 1st, over 30 days after your closing. You'll want to clarify this with your mortgage loan originator, as there are certain factors that can change this. It's worth noting that your principal and interest payment will not change for the life of the loan if it is a fixed rate loan. However, you will want to pay attention to your escrow account, so your taxes and insurance, as it is very common for changes in taxes and insurance to occur. The hope is that your property value will continue to go up over time, and in turn, you'll have more property taxes that will be due on the property. And your homeowner's insurance might also fluctuate on a yearly basis, so make sure to look out for your taxes and insurance and if there are any changes. So now we made it to the end. I hope this wasn't too overwhelming for you, although it is totally normal to feel overwhelmed when you're getting into something new or making potentially the biggest purchase of your lifetime in buying a home. I hope that I was able to answer some questions for you about the process along the way. I would highly recommend to keep watching videos like this to better educate yourself on the home buying process and real estate. And again, if you have any questions, feel free to reach out. My information will be in the description of this video. And you're well on your way to owning your first home. I'll see you in the next one.